How does a giant global corporation, a real titan of industry, just vanish? Well, it often starts with something that seems almost ridiculously small, a single fake number tucked away in an accounting ledger. Today, we're going to trace the path of that lie. We'll dive into two of the biggest scandals of their time, Enron and WorldCom, to see how they completely unraveled and sent shockwaves through the entire global economy. You know, this quote from the New York Times, it just nails it. It perfectly captured the feeling back in late 2001. Enron was this energy powerhouse. It seemed totally unbeatable. But under the surface, things were starting to crumble. You could just feel it. People sensed something was really, really wrong, way before they knew the whole unbelievable truth. And then you see something like this. This is the sheer scale of the lie at WorldCom. This isn't a rounding error, folks. This is not some optimistic forecast. We are talking about a $500 million swing from a supposed profit to a staggering loss in one single quarter. This right here is what cooking the books looks like in the wild.
So, how do we get from a single bad number to a global economic shock? Well, to get the full picture, we're going to follow the ripples as they spread outwards. We'll start with the crime itself. Then we'll look at the systems that should have stopped it. After that, we'll trace the fallout, check out the response, and finally ask that big question: have we actually learned anything?
Okay, so part one, let's get into the how. How on earth did a company like WorldCom literally manufacture profits out of nothing? It really all boiled down to one very clever and very, very illegal accounting trick.
I mean, that's the multi-million-dollar question, isn't it? It seems like it would be impossible, like some kind of financial magic trick. But it's not magic. It is a specific, deliberate, and calculated process designed to fool absolutely everyone. Investors, regulators, and the main weapon WorldCom used was this thing called capitalizing operating expenses. I know, it sounds super technical, but the idea is actually pretty simple. Think of it like this. An operating expense is your monthly rent. You pay it, the money's gone, that's a cost. An asset is like buying the house itself. It's an investment that holds value. What WorldCom did was pretend its rent was a mortgage payment. They took their day-to-day costs and illegally labeled them as long-term investments, creating billions in fake value. So here's how they pulled it off. Step one, WorldCom had billions of dollars in totally normal, routine costs, basically fees they had to pay to use other companies' telecom networks. But then, step two, and this is the crime, they just pretended those costs were assets. They moved them from the expense column to the asset column on the books. And then, step three, presto. With just a few keystrokes, billions in expenses vanished from sight and billions in pure fake profit appeared in their place. Simple, audacious, and completely against the law. You know, a fraud on this scale just doesn't happen in a vacuum. It couldn't. Which leads us to the next obvious question. Where was everybody? Who was supposed to be watching? This required a complete and total breakdown of all the systems that are supposed to prevent exactly this from happening. So yeah, who is supposed to stop this? Let's take a look at the so-called guardians of the financial system, the ones who were apparently asleep at the wheel while this was all going down. So, in theory, there are all these different lines of defense. The company has its own internal controls that are supposed to catch stuff like this. Then you have the board of directors, whose whole job is oversight. On top of that, you have external auditors who get paid to come in and verify the numbers are legit. And the whole thing is supposed to be governed by a giant rulebook called Generally Accepted Accounting Principles, or GAAP. And right here, this is where it all starts to get really murky. This shows a massive conflict of interest. Arthur Andersen was Enron's supposedly independent auditor, okay? They were paid $25 million for that job. But look at this. They were paid even more, $27 million for other consulting jobs. So you got to ask yourself, how independent can you really be when you have a bigger financial reason to keep your client happy than to actually do your job as a watchdog? And this quote, this is from an actual Enron accountant. It's chilling. It shows this wasn't some mistake. He said they aggressively used the rules to their advantage. They didn't see the rules as guardrails. They saw them as a playbook full of weaknesses just waiting to be exploited. The very system built to keep things fair was twisted into a tool for fraud. So, with the rules being exploited and the watchdogs looking the other way, this fraud just couldn't be contained. The collapse of Enron and WorldCom didn't stop at their front doors. It spread like a virus of fear and mistrust throughout the entire financial system. And just look at how fast it all happened. In the middle of 2000, Enron was a darling of Wall Street, trading for over $90 a share. Just a little over a year later, after a storm of scandals and investigations, the company was bankrupt. The stock was worthless. A corporate giant just vaporized in a matter of months. And the damage was so much bigger than just the company. Thousands of Enron employees didn't just lose their jobs. They lost their entire life savings, which were all tied up in company stock that was now completely worthless. And for the general public, trust in the market itself was just shattered. If a company this huge could be a total lie, who could you possibly trust? To really get your head around this kind of systemic shock, it helps to think about a historical parallel. A huge corporate scandal is basically a trade war for the financial markets. Just like tariffs can freeze up global trade by destroying relationships, a massive fraud freezes up markets by destroying trust. A perfect example of this is the Smoot-Hawley Tariff from the 1930s. The U.S. passed these huge tariffs, and other countries immediately retaliated. U.S. exports to those countries plunged by a third. Even exports to countries that just protested dropped by 15%. It just goes to show how one bad move can trigger this devastating chain reaction that paralyzes the entire system. That is exactly what these scandals did to the financial markets.
Okay, after a systemic collapse that catastrophic, a response is guaranteed. Lawmakers had to step in. They had to do something, not just to punish the guilty, but to try and rebuild trust in the whole system from the ground up.
The first and most direct response was the Sarbanes-Oxley Act, or SOX, which came in 2002. It brought in a whole bunch of new rules for corporate accountability and for how auditors have to behave. Later on, after the 2008 financial crisis, the Dodd-Frank Act brought even bigger reforms to the entire financial system. These laws were basically designed to plug the very holes that Enron and WorldCom had blown wide open. But here's the real kicker. After all the new laws, all the new regulations, who do you think actually ends up catching the fraud? Well, a huge study by PwC gave a pretty shocking answer. It's not the external auditors. They only catch fraud about 19% of the time. The single most effective defense against corporate crime, by a mile, is whistleblowers. Insiders who see something wrong and have the courage to speak up. They are responsible for exposing 43% of corporate fraud. So, all of this leads us to our final and most critical section. We've seen the crime, the breakdown, the fallout, and the response. But 2 decades later, are we actually any safer? Well, if you look at recent history, it's pretty clear the temptation is still there. In 2020, the German company Wirecard just collapsed after admitting that 1.9 billion euros of cash on its books just didn't exist. It was made up. And in 2023, Silicon Valley Bank imploded, partly because it was hiding massive losses on its bonds. The methods change, but the story is eerily familiar. And this high-pressure environment isn't just a thing of the past. It's happening right now. The leading economic index, which tries to predict where the economy is going, has been trending down. A negative number like this signals economic uncertainty. And that uncertainty creates the exact kind of pressure that forces companies to hit their numbers, which can lead to some really bad decisions, or worse. So we're left with this final thought. We have new laws, we celebrate the whistleblowers, but we also have new, incredibly complex financial products and the same old human temptations, greed, fear, pressure, that have been around forever. So have we really built a system that can withstand the next shock? Or are we just waiting for the next big one to come along and show us all the cracks we missed?